Welcome to Casual Finance. Today we dive into one of the hottest debates in tech and investing. Are we living through an AI bubble or are we witnessing the dawn of a true technological revolution? With headlines dominated by artificial intelligence, it's easy to get swept up in the excitement or the skepticism. In this video, we'll break down the arguments on both sides, look at the numbers, and compare today's AI boom to past tech manias. Let's start by understanding what's really at stake. First, let's talk about the sheer scale of investment pouring into AI infrastructure. We're seeing hundreds of billions, potentially even trillions of dollars being funneled into data centers, advanced chips, and the backbone of artificial intelligence. This level of spending is unlike anything we've seen before in the tech world. It's not just about flashy apps, it's about building the digital highways that will power the future. But who's writing these massive checks? Let's find out. Bulk of this investment isn't coming from small startups or speculative venture capital. Instead, it's the megacap tech giants, think Microsoft, Alphabet, Nvidia, who are leading the charge. These companies have the resources and the vision to bet big on AI. Their involvement signals that this isn't just a passing trend, it's a strategic move by the world's most powerful tech players. But does their dominance guarantee success or could it amplify risks? The bullish side, there's no denying the real consumer demand for AI products. Take ChatGPT for example, it's reached hundreds of millions of users faster than almost any technology in history. This isn't just hype, it's a sign that people and businesses are eager to adopt AI tools. Companies like Anthropic are also showing strong early revenue growth from enterprise clients. But is this demand enough to justify the massive infrastructure buildup? However, not everyone is convinced. Critics argue that while consumer interest is high, enterprise adoption of AI is still in its early stages. Most companies are running pilot programs, testing the waters rather than diving in. This cautious approach raises questions about whether the current infrastructure investment will pay off. For AI to deliver a solid return, it needs to generate significant recurring revenue from each user, a challenge that's easier said than done. Let's dig deeper into the numbers. To justify the massive infrastructure spending, AI needs to generate enormous recurring revenue per user. This is a high bar, especially when compared to previous tech waves. Investors are watching closely to see if AI can deliver not just excitement but sustainable profits. The question remains, can the current level of demand translate into the kind of revenue growth needed to support these investments? Some observers can't help but draw parallels to the dot-com bubble of the late 1990s. Back then, we saw a frenzy of investment, market concentration, and circular money flows, companies investing in each other, inflating apparent demand. Today, there's a similar fear that the AI boom could be driven more by hype and financial engineering than by real, lasting value. But are the similarities as strong as they seem? One of the hallmarks of a bubble is when money circulates within a closed system, creating the illusion of demand. In the current AI landscape, there are concerns that companies are investing in each other and using those investments to buy more chips and infrastructure. This can make the market look hotter than it really is, potentially setting the stage for a painful correction if real demand doesn't materialize. Despite the similarities, there are crucial differences between today's AI boom and the dot-com era. Most notably, the leading AI companies are already profitable with strong balance sheets and steady cash flows. They're not relying on speculative venture capital to fund their growth. This financial stability could act as a buffer, reducing the risk of a catastrophic collapse if the market cools off. Another important distinction is where the money is coming from. In the dot-com era, much of the funding came from venture capitalists chasing the next big thing. Today, it's the tech giants themselves, using their own cash flow to build out AI infrastructure. This shift in funding sources could mean that even if some investments don't pay off immediately, the overall system is more resilient. Oh, is this an AI bubble or something different? The video leans toward the idea of an infrastructure bubble. This means that even if there's a market correction and some investors lose money, the physical assets, like data centers and chips, will remain. These investments could provide long-term value, much like the internet infrastructure built during the dot-com era that still powers our world today. Even if the market experiences a correction, the data centers, chips, and other infrastructure investments won't just disappear. These physical assets can continue to generate value for years to come. This is a key reason why some experts believe the current AI boom is fundamentally different from past bubbles, where much of the value vanished overnight. Looking back at the dot-com era, many investments failed, but the infrastructure built during that time laid the groundwork for the modern internet. Fiber optic cables, data centers, and other assets survived the crash and enabled the digital economy we know today. The hope is that today's AI infrastructure will have a similar lasting impact, regardless of short-term market swings. AI's adoption curve has been remarkably steep. Products like ChatGPT have reached massive user bases in record time, signaling a genuine appetite for AI-powered tools. This rapid adoption is a positive sign for the industry, suggesting that the technology is meeting real needs and not just riding a wave of hype. Companies like Anthropic are already showing strong early revenue growth from enterprise clients. This suggests that businesses are finding value in AI solutions, even if widespread adoption is still in the early stages. As more companies move from pilot programs to full-scale deployment, we could see a significant uptick in enterprise spending on AI. Despite the optimism, skepticism remains. Some analysts worry that the current pace of investment is unsustainable, especially if enterprise adoption doesn't accelerate quickly enough. There's a risk that companies could end up with excess infrastructure and not enough demand to justify it. This is the core of the bear argument. For AI infrastructure to pay off, it needs to generate a high return on investment. Some estimates suggest that AI must deliver enormous recurring revenue per user to justify the current spending levels. This sets a very high bar for the industry and puts pressure on companies to deliver real, measurable value. If the anticipated demand doesn't materialize, the market could face a correction. Investors who bought in at the peak may see losses, and some companies could scale back their AI ambitions. However, the physical infrastructure will remain, potentially setting the stage for future growth when the market stabilizes. The optimistic view is that, even if there's a short-term bubble, the infrastructure built today will create long-term value. Just as the internet's physical backbone enabled decades of innovation, today's AI investments could power the next wave of technological progress. One of the biggest differences from past bubbles is the profitability of today's AI leaders. Companies like Microsoft and Nvidia are generating real profits, not just chasing growth at any cost. This financial strength provides a cushion against market volatility and makes the current boom less risky than previous speculative manias. Unlike the dot-com era where companies relied heavily on outside funding, today's AI investments are largely financed by internal cash flows. This means that companies can sustain their spending even if external funding dries up, making the industry more resilient to shocks. Another similarity to the dot-com era is market concentration. A handful of tech giants control the majority of AI investment and infrastructure. While this can drive rapid progress, it also means that the fate of the industry is closely tied to a few key players. With so much money pouring into infrastructure, there's a risk of overbuilding. If demand doesn't keep up, companies could be left with underutilized assets. However, history shows that excess capacity can eventually be absorbed as technology matures and new use cases emerge. Investor psychology plays a big role in bubbles. When excitement runs high, it's easy to overlook risks and focus only on potential rewards. The challenge is to separate genuine technological progress from speculative mania, a task that's easier said than done. The media plays a significant role in amplifying both the excitement and the skepticism around AI. Sensational headlines can drive investor behavior, sometimes fueling bubbles or triggering panic. It's important to look beyond the headlines and focus on the underlying fundamentals. Regulation is another wildcard. Governments around the world are still figuring out how to manage the risks and opportunities of AI. Regulatory changes could impact the pace of adoption and the profitability of AI investments, adding another layer of uncertainty to the market. AI is a global race with countries and companies competing for leadership. This competition drives innovation but also increases the stakes. The winners could shape the future of technology while laggards risk falling behind. Taking a long-term perspective is crucial. While short-term volatility is inevitable, the real question is whether today's investments will lay the foundation for decades of innovation. History suggests that infrastructure built during boom times can have lasting benefits, even if some investors lose out along the way. To sum up, the debate over an AI bubble centers on whether current investments are justified by real demand or driven by speculative mania. While there are risks of overbuilding and market correction, the physical infrastructure being created could provide lasting value, much like the internet's backbone after the dot-com crash. As we look to the future, the key will be watching how quickly real demand catches up with infrastructure investment. Whether we're in a bubble or on the verge of a revolution, one thing is clear: AI is reshaping the technological and financial landscape. The story is still unfolding, and only time will tell which side of the debate comes out on top.